Thank you for joining us today for our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, starting with our chart of the week, we asked the question here around, is energy a defensive sector? Now, this chart in blue shows the performance of energy relative to the broad S&P 500 index whenever there's been a 5% or greater correction all the way back to 2009. And what we can see is that pre-COVID, energy tended to underperform on broad corrections, but recently, energy's been an outperformer during corrections. Now, one of the main things I want to take away from this chart is that market relationships aren't static. Energy was an aggressive sector post global financial crisis because the biggest economic problem was sluggish growth. But since the pandemic, growth hasn't been the issue, it's been inflation. So inflation has driven market corrections, and energy has been an outperformer. Just sort of a PSA underscoring what the market is it's dynamic and relationships are constantly shifting. Now, looking at the economic backdrop, it's important to note that the global economy looks to be in pretty solid shape. This is a global recession probability model from Ned Davis Research, and it uses a wide variety of leading economic indicators. It's showing that the global recession probability is low for now. And there's been some green shoots for the US economy more narrowly as well. So this chart is showing the average of the manufacturing sector and the non-manufacturing sector. And we can see that it's recently turned meaningfully higher. This doesn't mean that everything is perfect. The Q4 GDP revision showed that the economy entered 2026 in something of a weak position, but recent data has picked up. Now, we did get the update on February inflation last week, and importantly, inflation remains below its average of the past 5 years. Historically, that's meant that inflation has not been a headwind for stocks. This was before the pop in oil prices, but important to note that inflation's been trending in a benign direction for some time now. Now, we think the Fed will be in a holding pattern here in their next few meetings, and that's because of the wild card that is commodity prices, and also that the economic data has been solid. The Fed's probably more neutral now than actively easing, but that's not been a bad condition for stocks historically. Now, one story that has captivated some media attention is scrutiny on private capital. This chart in blue in the top clip shows an index of the public market stocks for private capital investment firms. The orange line in the middle clip shows that these private capital companies, relative to the S&P 500, we can see that their stocks have certainly been under pressure since early 2025. And this has happened despite high yield bonds being pretty well behaved. So what that tells us is that investors are more concerned about capital flight than potentially the loans and the equity investments these firms have made themselves. Now, interestingly, manager dispersion has been very wide in private assets. This chart here shows the dispersion between top managers and bottom managers in multiple asset classes over the past 10 years. Note that in private credit, the top quartile of managers have delivered over 12% annual returns, while the bottom quartile have delivered less than 5% annual returns. Not only does manager selection matter, but so's this structure here that we want to use. These are illiquid investments, and the wrapper for these investments should match the illiquidity of the underlying. Now, that said, private credit remains a valuable portfolio component for the right investors. This chart here is showing the yield on various types of investments. Private credit continues to offer a yield pickup to public markets. Now, given the barrage of concerns over the war in Iran and private capital, it does make sense that investor sentiment has soured quite quickly. Historically, pessimistic sentiment has created solid buying opportunities for long-term investors. But we do need to pay attention to the trend evidence. There's been some deterioration in the long-term trend. This chart in orange shows the percentage of individual sub-industries that are in uptrends. It's currently just a little over 50%, Now, we want to see this reverse higher, but are cognizant that midterm years do tend to be challenging for investors. So, wrapping it all up, it's important to remember that market and economic relationships are dynamic. An example of that has been the relative performance of the energy sector since the pandemic. From an economic perspective, recession probability remains low for now, and inflation is not necessarily an issue for the stock market. The Fed is likely in a holding pattern, but that's okay for the stock market historically also. Private capital has been under scrutiny as it has attracted more retail flows and semi-liquid structures. We need to remember that manager and structure selection is important in private investments. And finally, investor sentiment has weakened amid some weakening trend evidence. We want to keep an eye on that, and we do remain cognizant that midterm years tend to offer investors a challenge, but the uptrend is intact for now. So that's what we have for you this week. And as always, I want to thank you for listening and wish you a great week ahead.